The South African Reserve Bank warns of risks to the country's financial stability. It says these risks, along with the threat of a grid failure due to repeated power cuts and persistent high inflation, have increased the systematic risk to the financial system. SARB says the fact of grey listing in February is the most notable risk to the domestic financial sector. The banking sector credit risk remains elevated as banks continue to extend credit at a faster pace than economic growth.
The rand depreciated by 8% since the previous FSR, while the basket of emerging market currencies appreciated by 3.5%. This underperformance of the rand was not only as a result of the grey listing. Other contributing factors included load shedding and the weak economic growth that follows, geopolitical risks, and which contributed to large capital outflows.
SARB says the longer the country stays on the grey list, the more lasting and severe the effects will be in the next assessment by FATF.
High transaction cost, more scrutiny for South Africa's financial payments and international payments and international participation by our financial institutions, generally an even higher country risk premium, which will increase the cost of funding in international markets even further, continued reputational damage and capital outflows, and there are also regional spillovers, as South Africa is in many respects the link of some of our neighboring countries to international markets.
The economy has been hit by a host of negative factors this year, such as the intense rolling blackouts, adding billions of rand to the cost of doing business and household expenses. The bank has also asserted the lingering recession fears and geopolitical tensions, which have also contributed to heightened systematic risk over the review period. Nothando Magbutulela, SABC News, Johannesburg.